Welcome to BuzzHouse, a Baker Tilly podcast where you can hear all the buzz around multifamily housing, with all the info you need to help you win now and anticipate tomorrow. Hi, I'm Don Bernards, the principal in charge of Baker Tilly's multifamily housing practice.
And I'm Garrick Gibson, a principal at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Let's get started. On the show, Garrick and I talk a lot about various financing structures and tools to help facilitate housing development. We like to look at new opportunities along with trends. On the borrowing side, we do know interest rates, while not historically high over the long run, are about as high as they have been over the last 15 years or so, making transactions more difficult to close and work. Today, we're very excited to bring back into the BuzzHouse Wade Norris, who's been a guest with us a couple times. Wade, thanks very much for joining us today. Wade's a partner at Dinsmore Law Firm. Many of you know Wade, and he's definitely recognized as one of the foremost authorities in the field of multifamily housing bond financing. Wade not only works on transactions, but has helped and continues to help shape policy and new financing tools. Before we start catching up with Wade, we're going to turn it over to Larissa Fogarty for this episode's Housing Happenings. Larissa?
Thanks, Don. Today's topic we're discussing in this week's Housing Happenings is Build America, Buy America, also known as BABA. As I mentioned on the last episode, the Road to Housing Act calls for a review of BABA, but across the affordable housing industry, stakeholders have also become increasingly active in advocating for practical reforms to the BABA requirements. Affordable housing industry groups have been engaging directly with federal agencies and lawmakers to highlight implementation challenges. These efforts have included formal comment letters, policy recommendations, and participation in listening sessions hosted by HUD, the Treasury, and the Office of Management and Budget. A consistent theme in this advocacy has been the need for clearer guidance, more predictable compliance standards, and expanded availability of waivers for materials that are difficult or expensive to source domestically. Earlier this week, Senators Jeanne Shaheen and Dave McCormick sent a bipartisan letter to Secretary Turner requesting to make reforms to the BABA process to support the construction and preservation of affordable housing. At the project level, developers, lenders, and housing agencies are also working together to manage BABA requirements through more proactive planning and coordination. In many cases, project teams are pursuing waivers where appropriate, particularly for specific product categories where domestic supply is limited or timelines would otherwise be jeopardized. In addition, there's also been a growing push to align BABA requirements more closely with existing federal housing programs. Stakeholders are advocating for standardized compliance frameworks across programs like the Low-Income Housing Tax Credits, HOME, and CDBG to reduce the administrative burden and avoid conflicting requirements. Some states and housing finance agencies are also taking an active role by issuing their own guidance, coordinating with federal partners, and incorporating BABA considerations into their underwriting and allocation processes. Collectively, these efforts reflect a coordinated push to refine BABA implementation in a way that maintains its policy intent while ensuring affordable housing projects remain financially feasible and deliverable. We'll continue to monitor how the BABA requirements evolve over the next few months and keep our listeners updated. Don, back to you.
Perfect. Thanks very much for that update, Larissa. Appreciate that. And now we're going to jump into our topic of the day, tax-exempt bonds. We're going to have questions for Wade around topics including just the general state of the tax-exempt bond market here in 2026, a few questions about various bond structures and the impact from the 50% test changing to, of course, 25%. And also an update on 501c3 and essential function bonds, which we've talked about at numerous times on the program. Now, Garrick and I are very excited to jump into our discussion with Wade. Garrick?
Thanks for that intro. And Wade, glad to have you back. I know you've been on the podcast BuzzHouse before. However, we probably have some new listeners. So before we jump in with some specific questions, why don't you give our listeners some insight into the work you're doing at Dinsmore?
Great. Yes. Well, my history in this space has been generally representing the buy side of tax-exempt debt and affordable multifamily rental housing financing. So my son, Reggie, who works with me now, and our team basically have been underwriters counsel where we have a structure of publicly offered tax-exempt bonds, often rated, or we serve as co-counsel to banks in private placements, which are a big part of the tax-exempt debt side of these affordable multifamily rental deals. We do the tax, securities, that aspect of it. We typically have real estate co-counsel to handle the real estate aspects of those private placement representations. And occasionally we will represent a borrower in an affordable multifamily rental deal where we have a really complex structure on the debt side of the deal to bring our experience, expertise, relationships into the picture to try to help the borrower make sure we're maximizing that part of the financing structure.
Perfect. So, Wade, thanks for the intro. I think we'd like to start the conversation off by giving our listeners an overall status of how you are seeing the tax exempt bond market in 2026 and how the tax exempt debt markets have changed since interest rates peaked and have plateaued since the fall of 2023, I believe, when we had you on last time.
Yeah, great. Thanks. As you, ladies and gentlemen, certainly know, and anyone who's seen me do these presentations before understands, I love to be a big picture sort of guy and look at the market as a whole and figure out what's going on, what's going to work best. But to do that, you need to really understand where the market is. And if you look at the recent history, you have to go back to the pandemic in the spring of 2020 when we got a $26 trillion economy. We had a $3 trillion problem, and the federal government, to avoid a 2008 financial crisis, started throwing money at it, fiscal stimulus, etc. And that was absolutely the right thing to do to avoid a crisis. People couldn't go to work, they couldn't go to jobs, you couldn't shop, etc. But we overdid it. Okay, we probably shoved 7 or 8 trillion fiscal stimulus at a $3 trillion problem. The result was, if you look at the municipal bond market, you had money flooding into the tax-exempt bond funds, which are about 25% of the tax-exempt municipal market each year. And they had to put it to work. So it drove rates down to extraordinarily low levels. If you look back at early 22, we had a 10-year treasury that was around 1%. It was actually 52 basis points in August of 2020, the 10-year treasury yield, if you can believe that. Turn the calendar back. Well, over the next 18 months, okay, to that peak in 23, you had the 10-year treasury rate going from around a 1% up to a 5% at the peak in the fall of 23, 400 basis points run up in rates over 18 months. Now, what happened when that happened? Well, money market funds went to 4 or 5% yields. Everyone wanted to keep their money in money market funds. And as a result, you didn't have a lot of investment going into long-term debt, like long-term muni bonds sold on the retail side. Well, once that stopped and rates started to plateau and started to drift back down, that money on the sidelines decided, if I'm going to lock in, see these nice high yields now, maybe I should go out longer on the maturity. Now, I'm going to start, maybe I want to buy some retail-oriented muni bonds to lock in good rates before rates go down. Everyone thought the discount rate was going to go down 6 times in 24. Well, that didn't happen. But nonetheless, rates drifted down. And we had a lot of money coming back into long-term debt investments. If you look at total bond volume in the muni markets, it was $400 billion a year in 2023, $400 billion. In 24, total volume was $500 billion with this money coming back in. Okay, 25, it was $580 billion as the money started coming back in. So we began to see retail executions work better. We had bond fund outflows. We now had bond fund inflows once again, not at the rate of 2021, but nonetheless inflows, not outflows, which really supported a change in the muni markets of sorts as we started having retail executions work better than they had been before. Things like your Fannie Mae MTEBs and other rated retail executions work better. And we're still enjoying a lot of that today going into 26. Now, if you look at what's happened to the 10-year, on February 27th, the 10-year yield was a 3.96, right around a 4. It had drifted back down to about a 4 over 2.5 years from the 5 in the fall of 23. February 28th, the war in Iran started. Since that time, rates have gone up on the 10-year. They went up to a 4.66 at the peak on May 19, and today they're about a 4.55. So we've had about a 50 basis points run up in rates since the war in Iran started and inflation concerns reasserted themselves. But that's not that major an adjustment. We still have a very healthy bond market. It's very healthy on retail executions, publicly offered deals. It's very healthy on private placements. And frankly, it supported a very good start to 2026. We've lost a little bit of ground, but we haven't lost that much ground.
Very good. That was very helpful, Wade, as we kind of think about the market in general, like that history and digging in. Wade, looking here in 2026, could talk about the 50% test, 25% test. There, of course, was a lot of speculation around the impact of that change, whether it be a lot more deals, what's it mean for pricing and cost and so forth. So questions like, Wade, what will the actual percentage of tax-exempt bonds be of a deal? So we talk about 25% test. Is it going to be 30%, 45%? Questions like that. Questions about the actual combined cost of borrowing. Was it increased because we had lower tax exempt, higher taxable? And are there other ideas to kind of enhance the amount of bonds you can get within the structure? So I know that was a lot packaged into one question.
That is a lot, but a lot has happened. So let's see if we can cover the high points here. And again, I assume Don and Garrick will make the link that I sent you to the publications Reggie and I recently released available to the audience, and people can look at any of these topics for a deeper dive. But if you think about it, thinking back to just May of a year ago, we thought we might not have any of this. We thought muni bonds might be taxable, not tax exempt. And we would have been in what I would have called the nuclear winter of affordable rental housing finance for a year and a half, until we figured out some other way. And instead, what we got was positive legislation. We got significant 12% increase in 9% tax credits to support these deals, 50% dropping to 25. The whole theory of that was it would take a more limited amount of private activity bond volume to prime the 4% tax credit equity that you have to have, funds 40% of most of our deals, to do an affordable rental housing deal where you're using volume limited private activity bonds and 4% tax credits. So the theory was you can do more deals, and that does make sense. And I think we will do more deals and are doing a bit more deals. But there are backsides to that, as you just pointed out. On the debt side of the deal, if suddenly my tax exempt debt, if in my total capital stack, if I start out with, say, 50 or 60% debt, and I'll have other perm tax credits and other perm lending sources coming in at conversion to stabilized occupancy. But if I start out high and now a good chunk of that debt through the conversion date is taxable, not tax exempt, and if that debt's trading at 100 basis points higher in rate, then suddenly on a debt service constrained loan, I've got lower proceeds. What is the impact of that pre-conversion? And if, depending on the size of the pay down at conversion, what's the impact of that post-conversion? We ran some very rough calculations, and one of the items in the handout will give you a little formula for doing this. But if you look at the debt side, there's a good chance if you in a 25% or 28% world versus a 53% world, with a significant portion of that debt through conversion and maybe after conversion to a certain degree being taxable, not tax exempt at a higher rate, how much are we losing as a percentage of total development costs? We think worst case, in a worst case deal, we're losing probably 2.5% of total development costs on the debt side of the deal. Federal tax credits, the tax credit equities funding, that's 40% of our capital stack. Maybe we have state tax credits for 10 or 15 or whatever. But nonetheless, it's still a big component of the capital stack. What's happened to tax credit equity pricing? Well, if you think about it, with 12% more coming in on the 9% deals and more deals, more demand for 4% tax credits because we're doing more deals on the bond 4% deals, I don't have a bigger demand necessarily. It's a $28 billion a year tax credit market. Fannie and Freddie went up from $1 to $2 billion a year. That helps a little bit, right? But on the other hand, I've got even more of that is demand. Well, one would think pricing will go down. So what we seem to be seeing, and this varies a great deal, is if it's gone down 5 cents, okay, then I've lost maybe another 2% of total development costs and proceeds on my deal. So I'm now had a 5 or 6% hit in a worst case scenario. Now, on the other hand, If it turns out that the spread isn't quite that wide, it's not 100 basis points, but a little bit lower. If it turns out that on the equity side, I haven't lost quite that much in pricing, maybe it's 2 or 3 points of total development cost that I've lost from 50 going to 25. But that's sort of a starting point, I think, on that analysis. The good news is in volume-constrained states, we still have a number of states that are oversubscribed, notwithstanding this, but nonetheless, it does provide more relief to do more deals, and I think that has helped.
Perfect. Very good. Thanks for those observations, Wade. Sticking to obviously bonds and the 25% test. So, a lot of talk about recycled bonds over the last couple of years. Probably even more so as you talked about the cost of capital. If I have lower volume cap, tax and bonds, can I layer it or kind of fit in these recycled bonds? What are you seeing in general right now in the market with these recycled bonds?
Well, I think it's important when you think about recycle bonds from the discussion we just had, if I've got incremental debt above that 28%, and it does, I should go back on that a little bit, going from 53 to 28, that's happening widely in California. In other states, it's not going down that far that fast. Colorado, for example, is stepping it down to 45, 40, etc., and they're phasing it in more slowly. Now, I think in 2 or 3 years, any state that is oversubscribed, as the substantial majority of them still are, will go down towards 28 or 30% or so. But nonetheless, it does differ from state to state. Now, let's say, for example, I'm starting out with my total capital stack, 50% of it is tax-exempt debt just because we need that on the front end of the financing or as debt. And only 28% of that is tax-exempt. So I've got a taxable tail for 22%. I'd much rather use tax-exempt recycle bonds volume for that, even though they don't prime tax credits. I've already got enough to prime the tax credits to get my lower rate on that part of my debt than using a taxable tail at maybe 100 basis points higher rate, higher yield. That sounds great until you realize what the real world looks like in the complexities of bond volume recycling. There are 8 or 10 major bond volume recycling programs around the country. New York City has invented this in 2014. They are very robust. California has CalHFA, and the largest, we helped the CMFA in California set up their recycling program in 2021. California gets over $4 billion of tax-exempt private activity bond and still allocates about 85% of that to multifamily housing. The CMFA is a very efficient, very effective issuer, a conduit issuer of tax-exempt bonds, and they probably do 60%, 55 or 60% of that almost $4 billion of multifamily volume. So they've got potentially, in a 50% world, they've got potentially a billion and a half of recycled bond volume a year. But Colorado has a very effective program. Washington State has a very effective program. There are programs around that can be used, but not every state does. If you look at Texas, it does not have a bond volume recycling program, and most states do not. And so one of the first questions you need to ask, given where my project is located, is there a program, that is up and running? In order to recycle bond volume, the theory of it is you have to capture the pay down of a prior bond issue, which is generally reducing the conversion on a private placement, the amount of bonds. You capture that volume, or the payoff of these short-term cashback bonds we're often doing under many structures now. But you have to capture it on the day of the pay down, and the issuer that is going to recycle that volume into a new qualified multifamily project under Section 142D has to have a credit line that they can draw on under tax theory. They send their money over to pay down those prior bonds, and the prior bond issuer trustee sends its money over, and they use that cash collateralize a credit line. Well, if you don't have a program and a credit line set up, and you're planning to use recycled bond volume, then that can take quite a bit of time, and you need to make sure that you are working with an issuer that can do it in the time frame you have on your project. And if there is an established program, you need to make sure you can get that volume, and then you can close your new deal within 6 months of that piece of volume that they've allocated to you, because after that, there's some steps you can take to try to extend it, but they're complicated and expensive. So it's not that easy in every situation to use recycled bond volume. Now, how valuable is it if you can get it? So if I've got a 100 basis point spread, and let's say the big question you then need to ask yourself is, what is the size of the pay down on my debt when I go to the stabilized permanent phase of my deal? If I start out with 50 or 60% debt and I pay down to 45 or 40 in the perm phase, I've still got a significant 15% or 20% taxable tail, and that can save me a lot of money. On that part of the debt, I may get 10 or 12% more proceeds if that is 100 basis points lower rate. So if I can get bond volume for that, in that scenario, I'm going to want to get it. Now, in many situations, particularly in high cost urban areas where there's a big pay down at conversion because you have all these other funding sources coming in, if I'm paying all the way down to 28 or 30%, and all I have on debt is during that 2 to 3 year pre conversion phase, yeah, I may save 100 basis points a year for 2 or 3 years, but that's not 10 or 12% increase in proceeds. And so if I have a pay down all the way down to say 25 or 30%, and in many high cost urban areas, that's roughly the case, then the complexities and cost of trying to use bond volume recycling, if it's available, can sort of outweigh the benefits in that scenario. So another very important question to ask.
Thanks for that insight. That was very detailed. I have a question on not recycle, but similar in terms of structuring. So we see many developers that they have been using the cashback structure with their tax exempt bond projects. So how are these cashback bond structures looking in the world with the 25% test?
That's a great question, Garrick. Thank you. So let's review that structure very quickly, okay? It used to be back, turning the calendar back on interest rates, as we discussed on the early part of the podcast here. When rates were so extraordinarily low, the interest coupon, the interest rate on a cashback bond was 1%. Okay. And in that environment, we use cashback bonds with FHA insured and rural development deals to prime that 4% test because the real funding there came from a sale of Ginnie Mae's in the taxable mortgage rate market, but we just wanted to flow that through a tax exempt bond issue to meet the 50% test and get our 4% tax credits. But there wasn't any other big incentive to use cashback bonds on other deals. Well, if you reflect again on the interest rate run up we had in 18 months between February of 22 and the fall of 23, the yield curve inverted and short term rates went up further faster than long-term rates, if you remember that. And that happened on short-term cashback bonds. The coupon on those bonds went from 1 to 4, okay? Now, let's take a typical tax-exempt private placement that we've developed with our bank clients over the years. The way those generally have worked is the bank or other sponsor, basically they'll do a variable rate tax-exempt drawdown loan during the pre-conversion phase, and they'll also commit to a perm rate on the amortizing portion of the loan once we've converted to stabilized occupancy. It's all in one package, very easy. The variable rates were low. There's no negative arbitrage on the new construction project. It was just a great structure, okay? But then when you get the higher interest rate, inverted yield curve environment that we moved into, now you've got very high rates on the construction loan side, so you sort of lost some of that. But what if we added cashback bonds on the front end of the deal to prime the 50% test, or now 28% test, if you will? What are the potential benefits of doing that? And this emerged with the yield curve inversion about 2.5 years ago on a much wider range of deals. So let's say I've got what would have been that typical drawdown tax-exempt private placement. I now add cashback, publicly offered, highly rated bonds on the front end. There was a big issue when this started 5 or 6 years ago as to whether or not you had a reissuance at conversion if you shifted from rated, publicly offered, AAA rated cashback bonds to an unrated, tax-exempt loan private placement. That's got to be a different debt. That's got to be a reissuance of debt, right? And over time, the bond counsel community has become comfortable that actually, the way the regulations work, if you actually have all the terms of that permanent debt defined when you close the initial deal, You've got the documents for that debt in the drawer. They're in escrow to be used if you reach conversion within the permitted time frame. You have the pay down, but the debt that is left tax exempt becomes represented by those documents. So all the terms of the debt have been defined on the front end with the cashback bonds. Those terms are totally defined. The back end is totally defined on day one. There's no modification of the debt. It's all set at initial closing. If there's no modification of debt, it's one bond issued throughout, one tax-exempt issue throughout. So 2 potential benefits. I've added cashback bonds now, and I've still got a forward perm loan private placement with a bank sponsor on the perm loan part of the deal, Freddie under their TEL program or that kind of thing. But the reason I've added the cashback bonds is, number one, the bond coupon is now 4%. And I've got a 2.5 or 3 year construction period. That's all that fully funded bond coupon at that percentage of basis is good cost, additional good cost, additional 4% tax credit basis. So suddenly I have a big boost in my tax credit basis and 4% tax credit proceeds by adding these cashback bonds to the deal. And if I have a longer construction period and you need 24, 30, 36, maybe a little longer, and if I'm in a QCT or a DDA and that'll get a 1.3% bump, I've now added a lot of proceeds to the deal. The second benefit, potentially, and this is true with almost all, but not all bond counsel now, is if you look at this under the IRS regulations on federal arbitrage, do you have to pay any excess earnings back to the federal government? Okay, that's a 5-year computation period when you use these kind of cashback tax-exempt bonds. And for the first, let's say, 3 years, I've got a 3% or 3.5% coupon now. That's still a lot of basis when you multiply by 1.3. But what is my yield on the Treasury portfolio we buy at initial closing to support those cashback bonds? Well, it's been 60 or 80 basis points higher than the 3% coupon. That's positive arbitrage. Now, if I blend the yield at 3 with a 6% yield for the last 2 years of the deal, I get a blended yield on the bonds that may be higher than the earnings yield. And if that's the case under this approach, that's really not positive arbitrage that you have to rebate under Section 148. You do have to apply qualified project cost, and bond counsel will require the borrower to say that, look, I'm responsible for rebate. If ultimately the IRS disagrees with this, I'm going to pay the rebate, whatever is owed. But the risk of that is so low that almost all borrowers say, that's fine, let's do that. Because let's say I've earned another 1 or 1.5% of total development costs in the 50% world by the increase in basis and proceeds. And I've got another point, let's say, of total development costs from the positive arbitrage, and I can now apply to qualified project costs. That's a 2.5 point increase of total development costs in the proceeds available on the table to do my deal. Yes, I want to do that deal. Now, as Garrett points out, what happens when you drop from 50 to 25%? Okay. Well, gosh, that percentages drove both sides of this, right? And it's just fallen in half. So that's great, Wade. You're telling me gross, you can get a 2% of total development cost net savings from this structure. And this year it's 1. Well, actually, there's some things that we have done and are doing to try to get that back up. It's not going back up to 2 or 2.25 or whatever, but we can get it back up to 1.5 in a number of situations and maybe a little bit higher. So it still works. We're still doing a lot of deals under this structure. People understand it. We've been doing it for 2.5 years. They understand the rules. We have the documents. We have the rating agencies understand it. And it still executes. It still adds additional cash to close the financing gap on a deal. And I can give you 1 or 2 wrinkles we're just doing if we got time on this topic, but you guys tell me.
Sure, we can take it and let's hear it out.
So here's an interesting idea, and this was first done about a year ago, but we're actually about to close one of these. So let's say on a typical deal, my construction loan, let's say I got $100 million financing in an urban area, high-cost area, $100 million financing, and I'm starting out with, saying 60% of that is debt, the construction loan. It's a bank making a drawdown construction loan. Now, if we're using cashback bonds, it'd be on at least that part of it a taxable drawdown construction loan. When you go away from the model, that becomes a taxable loan. But nonetheless, if I'm drawing down to 28% or so, I'll do cashback bonds at 28% on the front end for the reasons we just discussed to at least get the benefit out of that. But now let's assume that I decide, well, on the difference between that $60 million construction loan and the 28 or 30 I need with cashback bonds. What if I did an additional issue of short-term cashback taxable bonds? Why would you do that? Well, let's think about it. There's no positive arbitrage on those bonds because they're taxable. The coupon's not going to be a 3, it may be a 4 or a little bit higher. So if anything, I'm going to have a little negative arbitrage on that series of bonds that gets me up to the full amount of my construction loan. But how about the basis increase part of that? Well, there are some equity platforms now that are comfortable that no, that's just like on the other side. It's an increase in construction period interest. It goes into basis. It actually goes into basis at a higher rate during the construction period. So it's even a little bit bigger basis increase. Now you got the negative arbitrage offsetting part of that. You've got additional cost of issuance on that incremental series of cashback bonds offsetting part of that. But net, it can still provide an additional increase in the cash on the table at closing. That may get me up from 1 or 1.5 up towards closer to 2 again, if I'm able to do that. And this is very new. It is not widespread. But again, we close next Thursday. So another little twist that one of our bank clients have done is they've actually converted that taxable drawdown construction loan to a taxable municipal drawdown loan. So they actually just don't do that as a bank drawdown loan to the borrower. They do it as a drawdown taxable funding loan through the municipal issuer, through the CMFA, or whoever the issuer is. And then those proceeds go down to the borrower to cover construction costs the way it normally would. Why would you do that? Well, actually, for some banks, when they do their internal scoring and other analyses, there can be a benefit of having a taxable municipal loan on the books as compared to just a taxable bank loan. And so there are some benefits there, and we have one of those that we hope to close very soon that will add even additional net proceeds to doing the deal. So there are new twists and turns. These are just coming out, just being developed. We'll have to see how widespread it becomes, but there are things like this that we are doing that can help offset some of the negative advantages we've discussed of going from 50 to 25.
That's super exciting, Wade, and we'll have to have you back, of course, again to talk about what's new later this year. So really appreciate that.
Sure.
Wade, just one last question, switching gears a little bit to 501c3 bonds or essential function bonds with housing authorities. I know you're working with a number of these types of transactions. Garrick and I are as well with housing authorities and nonprofits that go through, especially those that might be enhanced, are going through the rating process of an S&P or Moody's or whatnot. Would you be able to comment what you're seeing in this space here in 2026 as well?
Yeah, the whole area of 501c3 bonds and essential function bonds has really grown dramatically in the last 3 to 5 years or so. If you look at what happened on private activity bond volume, there was a huge run up in the demand for it starting back in 2016 through 2021. And basically, that's when so many states became oversubscribed. And even though 50 going to 25 has helped some on that, it's still a big problem. And so when this happened, there were really 2 areas that we got into. There are 3 types of tax-exempt multifamily housing bonds under the Internal Revenue Code. The big one we talked about is under Section 142D. You have to get a private activity bond volume limitation, but you can syndicate 4% tax credits that covers 40% of total development costs. That has been, for many, many years, 90% of the game or more. But on the other hand, borrowers where they couldn't get the volume, they still want to see how can I make an affordable housing deal work. And under Section 145 of the code, not 142D, if we do a tax-exempt bond issue for a qualified Section 501c3 owner borrower and loan the proceeds to them, the issuer is still a governmental unit for it to be tax exempt, but we loan the proceeds to the C3. If one of their missions is relief of the poor and distress or lower income housing, there's actually a safe harbor RevProc 9632, and it has income requirements to satisfy that. But that is one way we've begun to look at doing deals where we can't get the volume, but we need an affordable housing deal targeted more to lower income, low, moderate income persons, 20 at 40% or 40 at 60, and then 75% at 80% of area median or below, 25% can be at market rate. Safe harbor exemption, done a lot of that. Now, more recently, the industries have begun to focus on workforce housing. What are we doing for people above 60 and below 120 or 140? And there's been a huge resurgence and growth in that area. And when rates were so low, we did $9 billion of that financing between April of 19 and early 22 in California and a little bit in Texas, one or two other states, where you would have a Joint Powers Authority in California, as a governmental entity, would be the issuer and the borrower, and they would issue these bonds at such low rates, and they could buy stabilized apartment properties, put them into lower income rental structures because they created real estate tax relief, and it was a huge thing. Now, the run-up in rates pretty much offset that, although we did close another one of these just 3 or 4 weeks ago, and we may see some of that beginning to come back. But that category, the owner of the project is a governmental entity in addition to being the issuer of the bonds, and the rules are very liberal. And if you can create real estate tax relief and make it work, it's a way to do a deal. The other big advance in these two areas, C3 bonds and essential function bonds, is on where you have a rated 501c3 corporation or a rated housing authority. So if I've got a rated 501c3 corporation with an investment grade rating, let's say it's A plus at S&P or greater, we can go out, and if it's that kind of a housing authority, it's got a balance sheet, it's got liquidity, it owns a number of properties, etc., audited financials, etc. And if that authority will sign a funding agreement, 8 or 10 pages long, where they agree if there's a shortfall on paying debt service in the 6-month period, we'll make it up. Okay, that gives me an A+ rating on the bonds. I get an A+ rating on the bonds. I'll put a 10 or 15-year maturity on it, very little or no amortization because they can handle the balloon with the balance sheet and liquidity. Suddenly you're borrowing at 475, not 6 or higher. So a lot of things work, okay? If I'm a C3 corporation and I can do that, then I can make that deal work much better. If I'm a rated housing authority, I may do an essential function bond deal where I'll buy stabilized properties, I will own them, and I can actually generate enough proceeds under that to acquire another property or two, make sure I'm keeping them affordable at workforce levels for residents in my community, and make that work without any big equity check at closing. So these kinds of things, there's been huge growth in the volume of these types of deals in the last 2.5 years. And I think we'll see a continued growth in that. There are 85 rated housing authorities. It's probably higher than that now. It's probably 100 housing authorities around the United States that are rated A or higher. And so it's an opportunity to do housing using these other parts of the Internal Revenue Code, these other two ways of issuing tax-exempt debt for affordable multifamily rental housing.
That's wonderful, Wade. Thanks. And now it's exciting to work on projects like that too. So that's it for this episode of the BuzzHouse, catching up with Wade Norris of the Dinsmore Law Firm, covering the state of the tax-exempt bond market here in 2026. Once again, I'm Don Bernards.
And I'm Garrick Gibson.
Don't forget to subscribe so you don't miss an episode. For additional resources around multifamily housing, check out bakertilly.com. If you have a suggestion for the show, email us at bild@bakertilly.com. That's BUILD @bakertilly.com. See you next time on BuzzHouse.